Welcome to another episode of Financial 15. Kevin and I are ready to go. We're tackling a topic today we get asked about all the time. I'm saving money for a down payment for a house. I've got savings for an emergency fund. Should I invest that money? We're going to give you an answer today. You want to stick around.
Yes, today a variety of savings and investment tips, things that you need to know. Again, if you want more information on this, please go to our website at beckerorr.com or like us on Facebook, or as always with the rest of these videos, please visit our YouTube channel, subscribe. You'll get all this plus much more to look at. So Clint, emergency fund, I'm saving for a down payment on a house. I want to put money away for a vacation. Should this money go in and be invested in the market, or what do I do with it? How do we tackle this question? Let's go.
Yeah, and this question comes up more and more because if you just leave it in the bank, you really don't get anything on it. So it just sits there, and I can understand the frustration. You're putting the money aside and you're getting essentially zero interest on those funds. So you're looking for a higher return, a higher growth rate. But before you get into that, I think there's a framework we have to tackle which applies to today, but also applicable for any investment goal. And you got to start with the end in mind. What is the goal? Exactly. Is it to build up the money because you're going to need it in 6 months for a down payment for a car? What is the idea? Or is this money you set and says, hey, I don't have to touch it for 10 years because that's part of a long-term plan? Start with the end in mind. Make sure you understand what the objective is. And then a second question for you, Kevin, related to that is you need to know the time horizon.
Yeah, time horizon is a really big one. I mean, are we dealing with something that you're looking for a vacation that you're taking in Europe in 2 years or 5 years? That's completely different than if I've got an emergency fund that I need to deal with possibly 6 months down the road. Or I'm going to be putting money on a house in the next 6 months and I got to put a deposit down there. The longer your time horizon or the shorter your time horizon should dictate what kind of initiative that you want to deal with in investing for whether I go long term, whether I'm going short term, and what options are out there for me. So a very important one. Again, in regards to the goal, you need to know how long you're putting the money away before that goal comes around.
Yeah, and what we're really doing here with the framework, what is the end objective? What is the time horizon? You're really trying to dictate the level of risk that'd be appropriate for this pot of money. Is it something where we can try to get a higher return, take a bit of risk? Or if it's a short time horizon and an immediate type of goal, well, perhaps we need to keep it very low risk. And we'll show why here. I'll pull up a bit of data to help out with that. And this is a long-term horizon. You're looking at the S&P 500 over almost 100 years. Put together here by Ben Carlson at wealthofcommonsense.com. And it looks at a couple of time horizons. Said, all right, a 1 year time frame, a 3 year, a 5 year. What is the probability of a positive outcome for the S&P 500 and a negative outcome? And you can see the longer the time horizon, the higher the percentage of positive numbers. The lower the time horizon, so if you need money in a year to buy a house, you probably don't want it in the market because there's a decent chance you can get a negative return. And I'd rather get 0 or 1% at the bank than lose money. I don't want to take that chance if I need the money in a short time period. And that's really the risk here that we're getting at. Is anything that touches the market, yes, potential for higher return, but we will have to deal with some short-term pain in order to get that. And that's really the trade-off.
Yeah, I mean, and basically, if we take a look at it, these are really betting odds that you're looking at. I mean, and it depends on what that money's for. Again, if you're looking for something where you have to protect your principal or you need that amount of money to go down, you really can't afford sometimes to go those betting odds. I mean, 3 out of 4 is a great option, but if you're in that 1 out of 4 category, all of a sudden now you're scrambling to do something else. And if we take a look at it here on a longer term time frame, again, we see that, that 1 month scenario, maybe I need liquidity now for my emergency fund. If I stick it in the market, actually only 60% of the time am I ever going to get a positive return. And that's based on a whole 100 years. Now, if I've got 20 years before I need this money and I'm planning a vacation trip, to take my family away when I retire, chances are I can put it away for that long and I am going to be in a positive market, but I don't have to touch it. I don't have to worry about up and downs in the markets or anything along those lines. And again, these are based on a rolling, basically 100-year average. If you're stuck in the middle of a recession, 1 month may be a lot different there than you get it over a long time frame. But as we can see, the longer you go, of course, the better your odds are. But again, that's going to be time horizon depending on what your goal is, right?
Absolutely, absolutely. And the idea here is if you're asking yourself those questions, what is the goal? What is my time horizon? And often for savings, the time horizon is going to be short. usually don't start saving to buy a house 20 years from now. You start saving to buy a house because you're hoping to buy a house in 3-5 years, which means likely you don't want it to touch the market, because you're going to be taking too much risk if you try to step into that, because the risk is that the market goes down, which does happen in those time periods, as we're seeing with the probability numbers here. The risk is you don't have enough to buy a house then, or you don't have enough to buy your car or achieve whatever the goal is. You could fail in accomplishing your goal because you took too much risk on the investment. So to avoid that scenario, often we keep it lower risk and we avoid the market. And to put a finer point on it here, Kevin, I'll set this up for you. You have to think about it kind of in a benefit and a cost, kind of the pros and cons, the risk reward, if you will. And we have a quick example here to help illustrate that.
Yeah, I mean, basically, let's assume that you're saving $10,000 for a home renovation. You want to plan to do that over the next, it could be 3, 6 months, or a year. Now, if you get 1% just by tucking it away and saving on it, that's one thing. But hey, if you can invest it into the market and say get 5, that sounds like a great idea. 5% versus 1, I'd love to do that. Let's do that. But all of a sudden, if you look at it at the end of the day, the number, that's an extra $400. In today's world, I don't know what you can repair on your home for $400. It's not a lot. I guarantee you that. May pay for the labor on something, but it ain't going to get you anywhere. So theoretically speaking, you may get 5. By the same token, you may lose 5. Are you willing to take that risk to be able to deal with this? So depending on the dollar value that you're dealing with, you could be looking at minimal amount that you're actually getting in terms of real dollars, as opposed to what it looks like in terms of percentage gain. And that's a huge factor that you have to consider depending on what this money's for. Is it for vacation funds? Is it for an emergency play? Is it done for the home renovation as we talk? I mean, these are things that we really have to take into consideration, don't we?
I would agree. Absolutely would agree. The idea here is to get a risk reward framework where you're saying, okay, what's the potential reward? Well, in this case, if it's 10 grand for home renovation, well, maybe it's a couple $100 if everything goes well. What's the risk? Well, the risk is things don't go well, you'll lose money, and then perhaps you can't do the renovation as planned. In my opinion, the risk there kind of outweighs the reward. So I wouldn't take that particular approach, but understanding that framework will help understand why often we suggest not investing the savings and just keeping it as it is. So a couple of tips here to help out on that regard. Like I just mentioned, keep it safe and readily available. So if it's an emergency fund, well, you might need that money. The idea is you don't know when the emergency happens, so you always want it to be available. Or if you're saving for a house down payment or for a new car, if you have a short time horizon, keep it safe, keep it readily available. Often that means it's just going to be high interest savings accounts, maybe a term or a GIC, depending on your time horizon, but nothing too risky, because often, like we just talked about, the risk you're taking might not be composite to the reward you're trying to achieve there. So safe, readily available, often good tips for savings account. And this is a big one here, Kevin. I think it's just because of the way they put the name, but I'll let you tackle that burden.
Yeah, I mean, a lot of times people will come up and we get asked all the time, I want to put money away for a house, or I'm looking to put money away for a vacation. Can I keep my emergency fund in my TFSA? I mean, technically, yes, you can, but is that the best option? We would happen to say probably not. As we say, it's a tax-free savings account. We've said many times this is more or less a misnomer. It should be listed as a tax-free investment account. These are for purchases usually longer down the road, or for savings longer down the road for other opportunities. We would always, as we say, recommend something that's really liquid, really quick. If you've invested money in a TFSA and you've put it into investments, it may not be as liquid as you need it for an emergency basis, or for that down payment. You need to put the down payment down 2 days from now. You may not be able to get that quickly. So again, this is not really where we would recommend using that short-term money that I need principal protected savings sort of scenario. It's just that it's more of an investment play, as we've always said. And again, it's something to take a look at going forward.
Yeah, and part of it also, you have limited tax-free savings account room. It's not as if there's an unlimited amount, right? They put a cap on how much you're allowed to contribute to the account. So ideally, since you have limited space, you want to get the best bang for your tax-free dollar. So usually your longer-term investments can give you that higher return on average. So that's typically what you want to do in your TFSA to get the most out of those tax-free dollars, as opposed to using it more as a traditional savings vehicle. So if you're saving for a down payment for a house, a car, vacation, whatever it is, high interest savings or a traditional savings account might be the better bet. I know it's not fun to see the low returns, especially in this environment, but like we just talked about, you don't want to take the risk, and you probably want to take the most out of your TFSA, which means using it for those longer term investments. So we did that in a quick fashion, covered a couple of items on how to tackle that particular question. Should you invest your savings? If you have other questions, Kevin, where do you want folks to get a hold of you?
I want folks to get a hold of you or me at chatwithclintonandkevin.com. By all means, we have more than enough answers probably to answer your savings questions. And again, everybody's in a different boat. It could be emergency, it could be vacation, it could be down payment, whatever you're looking for a savings tool for and whatever your risk factors are. If we can answer that, that's going to be the easiest thing to do. Give us parameters as to what you want to look at, and we'll tell you what we think are the best options going forward. Now, besides that, you can also find out any of the other videos that we put out there that deal with savings or TFSA or something along those lines, because each part has something to do with your financial plan, and we're here to help out with that any way we can. So that's all I have. Closing comments are yours, Clint. What do you want to say?
I think you covered it all there. So I'll just say keep safe, everyone. We'll be back again very soon. Take care.